I was at a dinner recently, sitting between two very different types of investors. On my left was a man who talked about his portfolio with the calm certainty of a historian, his star player, BlackRock. He didn't talk about quarterly earnings or growth potential. Instead, he described it as a fundamental force, something as permanent and unshadable as gravity. For him, investing wasn't about betting on the future. It was about earning a piece of the system that governs the present. He saw its dominance in its silent, pervasive control over global capital. Then, the person on my right, an artist and programmer, just smiled. She said that's like admiring the pyramid after it's already been built. Her money was on NVIDIA. When she talked about it, her language completely changed. It was all about potential, about creating the tools for the next era of human intelligence. She wasn't investing in a company. She was investing in computational energy, in the engine of imagination itself. To her, dominance wasn't about control. It was about perpetual, relentless innovation. And listening to them, I realized they were both describing the same thing, dominance, but from opposite ends of the universe. One saw it as the unmovable object. The other saw it as the unstoppable force. It raised a fascinating question. Which is the truer form of power? The one that controls the world as it is, or the one that builds the world of tomorrow? That tension, between controlling the present capital, the sort of gravity of the system, and engineering future potential, the sheer force of innovation, that's really the defining conflict, I think, in modern commerce and investment strategy.
It really is.
So today we're doing a deep dive to analyze this strategic interplay. We're looking at these two forms of dominance capital control versus perpetual innovation. How do they define market leadership? How do they structure long-term investment portfolios?
Yeah, and specifically how financial giants, the BlackRock types, and the tech leaders, the NVIDIAs, are reshaping things.
Right, and maybe even learning how to merge those two sides, the stability and the velocity.
Exactly. And to really get under the hood of this tension, we have to admit that the old ways, the traditional methods, they just aren't quite enough anymore.
How so?
Well, traditional quantitative finance, it emphasizes stability, right? It looks at historical data. So naturally, it leans towards favoring the unmovable object, the established power, the controlled capital.
Like BlackRock in that dinner story?
Precisely. But in a world that's being driven by exponential tech growth, that approach is, well, it's incomplete. You're missing the unstoppable force side of the equation.
So our mission today is to try and integrate those, the quantitative logic with the qualitative side, the insights into disruption.
That's the goal. We need to figure out the mechanisms required to actually quantify future potential. How do you put a reliable number on human imagination, on technological breakthroughs?
Which sounds incredibly difficult.
It is, but that's the challenge. And then we need to see how that quantification is being used to build investment strategies that are resilient, that aim for high growth, and that really span both sides, both the gravity and the velocity, as you put it.
Okay, let's start then with quantifying that unstoppable force. It feels like AI, particularly large language models, is the key tool here, right? Transforming financial analytics.
Absolutely. We're moving past models that just look at charts and historical returns. The big shift is asking models to understand human language, context, the story behind the numbers.
Which is a huge leap.
It's profound. LLMs, they possess genuinely enhanced reasoning capabilities compared to older AI. And crucially, they're good at integrating multimodal data, meaning they can process numerical data, like stock prices, alongside massive amounts of unstructured text, think economic reports, news articles, analyst commentary.
Which traditional models just couldn't really handle.
Not effectively. They're mostly built for numerical patterns. LLMs, though, trained on just immense amounts of text, have shown some, frankly, astonishing performance. We're talking about models capable of passing really tough professional exams, like the CFA exam.
Wow, the Chartered Financial Analyst exam. That's significant.
It is. And studies show they can demonstrably outperform experienced human analysts in specific tasks, like predicting changes in corporate earnings.
Okay, just passing the CFA suggests a huge shift in what financial expertise might even mean down the line. But applying these massive general-purpose AI models to the, let's face it, often chaotic and irrational financial markets, that sounds like a real challenge.
Oh, it definitely is.
How do researchers make sure these models get enough relevant, high-quality information? Because I've seen those studies, too, where a general LLM doing, like, zero-shot prediction
meaning no specific training examples.
Right. It actually did worse than simple statistical models sometimes, maybe because the context was just too broad or noisy.
That's precisely the core methodological hurdle. And it really highlights why specialization is so important here. The answer isn't just throwing more data. It's moving away from those generic zero-shot predictions.
Towards something more focused.
Exactly. Towards meticulously building high-quality context sets. One really effective approach uses those daily reports from securities firms, the ones analysts write.
The kind institutional investors rely on.
Yes. But instead of feeding the whole, often lengthy report into the model, you segment the text. You identify just the key textual factors that analysts believe are influencing future market movements.
So you're filtering the noise.
You're filtering the noise and extracting the signal. These concise textual summaries are then bundled with structured numerical data, historical prices, trading volumes, things like that. This process minimizes the irrelevant stuff and maximizes the useful context the model needs for a targeted prediction.
So the secret sauce isn't just big data, it's curated data. It sounds like you're essentially translating the subjective language of analysts' strong headwinds or promising outlook into hard data points a model can actually use.
That's a great way to put it. You're quantifying the qualitative.
How does that translation physically happen? What are the mechanics behind it?
It's mainly done through really sophisticated prompt engineering and a systematic scoring process. Researchers design a specialized prompt, basically, a set of instructions for the AI.
Okay.
This prompt guides the AI to analyze the segmented text and assign objective numerical scores to those key factors we identified earlier. It typically uses something called a Likert scale scoring system.
Like those 1 to 5 satisfaction surveys.
Exactly like that. Maybe 1 is maximum pessimism, 5 is maximum optimism. So a factor suggesting, say, unexpectedly strong earnings might get a score of 5. And importantly, the model usually has to justify that score by generating a rationale directly from the source text it analyzed.
So the AI generates the insight, justifies its reasoning based on the text, and then scores it. That sounds like it enforces consistency, right, across potentially hundreds of different analyst reports.
Precisely. It creates a standardized process. And then, of course, that score needs to become actionable for prediction.
Oh.
It goes through a rigorous scaling process. This transforms the somewhat subjective Likert score into a standardized numerical value that can actually be fed into a market prediction algorithm as an input.
Okay, that makes sense.
And there's another layer to keep the model sharp. They use a dynamic learning process called few-shot examples.
Few-shot examples.
Yeah. Instead of learning only from a fixed historical data set, the model gets a small set of highly relevant, successful historical examples, the few shots, right before it makes a prediction. And crucially, these examples are dynamically updated based on the query time.
So it gets a fresh cheat sheet relevant to right now.
Basically, yes. It gets the best, most recent, most relevant historical data points to learn from just before it attempts a prediction. This is vital for accuracy in fast-moving financial markets.
That does sound incredibly advanced, but, the proof is in the pudding. Does it actually lead to better performance compared to the established financial time series models?
Well, the experimental results are certainly compelling. In trials using indices like the KOSPI 200 in South Korea, which is a good test case, high volatility, lots of liquidity.
Right.
The LLMs consistently outperformed traditional time series models. We're talking about models like ARIMA, which relies heavily on past averages and time trends, and LSTM networks, which are usually pretty good at understanding long-term patterns and sequences.
And the LLMs beat them.
Yes, especially when using a short look-back window, often denoted as Allen-Taylor 1 in the research.
Sure.
Meaning the model was focused on predicting the price change over just the very next trading period, like the next 2 days. This suggests the LLMs are much better at capturing the immediate forward-looking impact embedded in those analyst reports, even considering the slight delay before reports become public.
That's interesting. And beyond just the accuracy numbers, I imagine the transparency this process offers must be a huge advantage. Traditional quant models, especially complex neural nets, often get criticized as being impenetrable black boxes, right?
That's a primary benefit, absolutely, and a real strategic advantage for adoption, because the LLMs are prompted to break down the info, identify factors, score them, and justify the scores.
They generate rationale.
Exactly. They generate detailed rationales alongside their predictions. This provides a dramatic increase in transparency compared to just getting a number stat out by a black box. A portfolio manager can actually read the rationale and understand why the model is suggesting a certain move. It's not just an output. It's an output backed by summarized textual evidence.
That makes sense. But we have to address the limitations. If big institutions are potentially trusting billions to these models, how do they grapple with the remaining issues, particularly around, say, reproducibility?
That's a critical point of friction, no doubt, and something large financial firms must tackle head-on. There are two main challenges that persist. First, reproducibility.
Meaning getting the exact same result every time?
Right. While the experimental results across many trials were highly consistent, often showing correlation coefficients above 0.85, which is strong.
Okay.
They don't always generate perfectly identical outcomes or rationales on every single run.
Yeah.
You have to accept a degree of, let's call it, reasonable, non-identical variation.
Which could be tricky if you're justifying a massive trade, right? If the model said slightly different things yesterday and today, even if both pointed the same way.
It's a challenge. The answer likely lies in setting very stringent standards for that correlation coefficient, demanding high robustness, but also acknowledging that the sheer complexity involved means perfect, bit-for-bit repeatability might often be impossible. You manage the risk around that small variance.
Okay. And the second limitation, you mentioned true explainability. Even with a text rationale, it's different from understanding the model's internal math, isn't it?
Absolutely. That's the second point. While these text-based rationales offer a huge leap in transparency compared to a pure black box, they still provide limited true explainability compared to traditional model-based methods.
What's the difference?
True model-based explainability involves digging into the model structure, analyzing specific mathematical weights or features to understand how it arrived at a score. The LLM's rationale is more like a very well-written summary of why it decided what it decided based on the text it saw. It's not a direct window into the deep neural network's calculation process.
So it's an improvement, but not the final word.
Exactly. It's a significant advance. But achieving fully explainable AI in finance likely requires even deeper integration of these quantitative and qualitative methods down the road.
All right, so we've seen the precision these new quant models are aiming for in quantifying future potential. Now let's shift gears and look at the sheer, almost overwhelming scale of that unstoppable force itself, particularly the concentration of capital and innovation in big tech. You mentioned Apple, Amazon, Alphabet, Meta, Microsoft.
Yes, the scale here it's truly paradigm shifting. This is where the unmovable object of deep capital directly fuels the unstoppable force of innovation.
How big are we talking?
Just look at 2024. Those 5 companies alone invested a combined $227 billion in research and development.
$227 billion.
Billion, yes. Now, put that in perspective. The entire U.S. federal non-defense R&D budget for that same year was around $172 billion.
So 5 private companies are outspending the U.S. government's non-defense R&D budget significantly.
By about $55 billion. We're talking about private corporate R&D efforts that don't just match, but substantially dwarf national initiatives aimed at broad scientific progress.
That immediately raises some pretty big strategic questions, doesn't it? When private industry controls R&D at that scale, they effectively control the direction of future tech, the talent pool. They have a massive speed advantage over government or academic research.
That's the core implication, yes. They attract top talent with high salaries, and they absolutely set the agenda for technological development. And R&D is just one piece.
Right. Innovation needs infrastructure.
Massive infrastructure.
Yeah.
That same year, 2024, they also collectively invested over $250 billion in capital expenditures.
$250 billion.
Yeah. And this isn't money for advertising or fancy offices. This is hard capital, the money needed for building and maintaining the enormous GPU clusters essential for AI training, for quantum computing experiments, for vast global data centers.
We saw the cost of that earlier with the AI models. You mentioned GPT-4 training.
That's a perfect example. Training just one competitive large language model like GPT-4 likely cost upwards of $100 million in compute resources alone for one training run.
Wow.
These escalating capital requirements create huge natural barriers to entry. This is that synthesis we talked about, the unmovable object of deep capital, enabling the unstoppable force of cutting-edge innovation. Only organizations capable of deploying capital on this scale can realistically compete at the technological frontier anymore.
And it's not just about building products people buy. These companies are fundamentally building and earning global infrastructure, like the nervous system of the internet.
That's a very apt analogy. They're financing hyperscale data centers, the renewable energy projects needed to power them sustainably, even designing their own custom chips like Google's TPUs or Amazon's Graviton processors to optimize performance and reduce reliance on companies like NVIDIA, actually.
Reducing reliance on the other unstoppable force. Interesting.
And critically, they own or lease significant stakes in the physical infrastructure of the internet, at least 16 major subsea communication cables globally. Think about Meta's Candle cable in Asia, or Google's Equiano cable boosting capacity to West Africa. They are, quite literally, becoming the landlords of the world's digital highways.
Which makes everyone else, businesses, nations, increasingly dependent on their plumbing.
Exactly. And this private innovation generates enormous strategic value for the state, too. This idea of a dual-use dividend.
Explain that.
It means that the $200 billion plus these companies spend annually on commercial R&D creates cutting-edge technologies that the U.S. military and intelligence communities can then rapidly adapt for defense purposes.
So the government benefits without footing the initial R&D bill.
Largely, yes. We see concrete examples. Microsoft's HoloLens tech evolved into the IVS augmented reality headsets for the Army. And think about the massive cloud contracts, the Pentagon's JWCC program, the CIA's C2E cloud environment. These rely heavily on the infrastructure built primarily for commercial markets. The government gets state-of-the-art, market-tested capabilities at a fraction of the development cost.
It sounds incredibly efficient from the government's perspective, although maybe it raises questions about becoming too reliant on a handful of private companies for core national security functions.
That's a valid debate, absolutely.
But what about spreading the knowledge? Given how valuable this innovation is, how does it diffuse beyond these giants into the wider economy? Is it all locked up?
That's actually a surprising aspect, especially compared to older corporate R&D models where everything was kept fiercely secret. These companies publish thousands of peer-reviewed research papers every year.
Really?
Yes, and they release foundational software frameworks as open source, think Meta's Llama models for AI research, or Google's TensorFlow library for machine learning.
Why would they do that? Give away valuable IP.
Well, there are strategic reasons. It helps set industry standards around their tech, attracts top academic talent who want to publish, builds developer ecosystems. But the practical effect is a massive diffusion of knowledge throughout the global tech community.
Can you give an example?
The classic one is Google DeepMind's AlphaFold. They used AI to predict the structure of virtually every known protein, over 200 million of them, and then they just released the entire database publicly for free.
Wow.
That single act likely accelerated progress in biomedical research worldwide by years. It's a different model of innovation diffusion than we've seen before.
And maintaining this huge domestic scale, why is that so critical in the sort of global competition for dominance, particularly against state-backed rivals?
It's essential because this concentrated scale in the U.S. private sector provides the necessary economic and technological counterweight primarily to state-backed competitors in China.
Because they operate differently.
Completely differently. Chinese tech firms often benefit from massive state subsidies. Beijing launched a $138 billion fund specifically for quantum, AI, and semiconductors. They operate within a tightly integrated state corporate system using mercantilist strategies. The sheer scale of American private investment, driven by the profit motive but also diffusing knowledge, is the critical leverage needed to compete long-term and prevent essential global infrastructure from being dominated by foreign state-controlled entities.
Okay, so we've mapped out the precision of quant models trying to value the future and the immense scale of capital needed to build that future. Now let's bring it together. How are the smartest players blending these two types of dominance, this idea of quantum mental investment?
Right, this convergence. It's really not optional anymore if you want to navigate today's volatile, tech-driven markets effectively. Quant models bring that essential discipline. They systematically remove human emotion, fear, greed from day-to-day trading decisions. They act as a constant evidence-based check on crucial factors like valuation, momentum, quality across potentially hundreds or thousands of stocks simultaneously. They provide the stability, the control aspect across a broad, diversified portfolio.
But surely the human element, the fundamental analyst's judgment, is still needed, especially for those weird, unpredictable events, the black swans?
Indispensable. Quant systems are brilliant at identifying patterns and managing large portfolios based on historical relationships. But they can struggle with truly unique, low probability but high impact crises.
Like what?
Like a sudden, massive short squeeze driven by social media trends, something models weren't trained on, or a major geopolitical event that instantly changes the regulatory landscape for an entire sector. A model might be too slow to react or might not interpret the event correctly.
You need a human?
You need a fundamental analyst, someone with deep industry knowledge and real-world context to make those critical judgment calls in the moment. To decide to sell based on clear contextual risk, maybe even before the model's data fully reflects the new reality. It's about overriding the system when necessary.
Is this integration actually leading to new kinds of investment strategies, things that simply couldn't exist before?
Absolutely. We're seeing concrete examples emerge. One example is the co-development and launch of strategies like the Dynamic Theme Machine, or DTM.
Dynamic Theme Machine. Sounds interesting.
It is. It uses alternative data sources, things beyond traditional financial reports, like satellite imagery, social media sentiment, supply chain tracking data, and combines that with advanced natural language processing, like the LLMs we discussed.
To do what?
To detect emerging market themes long before they hit the headlines or show up in standard analyst reports. It tries to blend the speed and precision of quant timing, knowing when to get into or out of a theme, with deep, fundamental thematic analysis, understanding what theme is actually meaningful and sustainable.
So it's marrying the quant's when with the fundamental analyst's what and why.
Exactly. It's a perfect example of synthesizing the two forms of dominance, quantitative precision and qualitative insight.
Now, to make that kind of collaboration work, consistently getting quants and fundamental analysts to truly partner effectively, that must require a very specific kind of organizational culture, right?
Oh, absolutely. It demands a genuine research culture.
Yeah.
And at the core of that is a commitment to an idea meritocracy.
Meaning the best idea wins no matter who suggests it.
Precisely. Whether it comes from a junior coder straight out of university or a senior portfolio manager with decades of experience, the idea is judged solely on its evidence and logic.
And that culture needs to encourage risk-taking.
It has to. It must actively fight against complacency by encouraging projects that challenge the status quo, even if they seem risky or counterintuitive. And critically, the organization needs to be structured so that people feel safe proposing ideas, even if those ideas are ultimately dismissed. There can't be a penalty for suggesting something that doesn't pan out after rigorous debate. Failure tolerance is key fuel for innovation.
That sounds good, but how do you actually build and maintain that? What are the practical components of a healthy team culture that avoids groupthink?
You look for several key things. A relatively flat organizational structure helps ensure diverse perspectives aren't filtered out by layers of management. Second, that unwavering commitment to evidence-based meritocracy we mentioned. Third, you need mechanisms for continuous fresh perspectives, maybe rotating project leadership, actively recruiting people with different backgrounds and ways of thinking.
And encouraging debate.
Vigorous, objective, collaborative debate is essential. The focus must always be on challenging the evidence or the logic, never the person presenting it. The moment communication gets siloed or people become hesitant to question a senior person's pet hypothesis, that's when groupthink creeps in and innovation starts to wither.
Okay, let's pivot slightly. How are these quantitative approaches helping to integrate less tangible qualitative values, specifically something like sustainability, into traditional investment portfolios? The unmovable object of big capital pools needs to reflect evolving client values.
Sustainability investing has undergone a massive transformation, largely enabled by quantitative techniques. It's moved far beyond simple ESG exclusions, just deciding not to own tobacco or fossil fuel stocks.
Right, that was ESG 1.0.
Exactly. Now it's about complex customization. Quants can systematically analyze thousands of companies across a huge range of proprietary data points related to environmental, social, and governance factors. This allows investors to tailor portfolios very precisely, for example, targeting specific carbon reduction goals or ensuring alignment with particular UN Sustainable Development Goals, the SDGs.
And this leads to a different way of thinking about portfolio construction itself.
It does. It enables what some call 3D investing.
The 3D.
Yeah, the idea is you're optimizing simultaneously across three dimensions: sustainability, risk, and return. You treat all three as integrated measurable inputs into the process.
Which is a big shift.
Huge. because traditionally choosing an ESG fund often meant implicitly accepting potentially lower returns or different risk profiles because you were restricting your investment universe by excluding certain companies or sectors. Now, the goal is to actively optimize all three metrics together, which requires sophisticated quant analysis to manage the trade-offs.
But how do you quantify something as broad and frankly subjective as an SDG goal, like reducing inequality or promoting decent work? How does that become a number a model can use?
That's the core challenge and where a lot of the innovation is happening. Sustainability is inherently multifaceted. It's not just about easily measured things like carbon emissions, though even that isn't simple.
So how do quants handle the fuzzier stuff?
They have to develop sophisticated methods to translate these qualitative, often holistic dimensions like labor practices, impact on local communities, alignment with complex SDG targets into measurable numerical scores and factors. This often involves using alternative data sets, again, alongside complex scoring models, to turn those subjective values into hard numbers the optimization engine can work with.
And giving clients this level of control over the portfolio's ethical or sustainable shape must be powerful from their perspective.
It's absolutely critical for client engagement and retention. Proprietary software platforms built on these quant engines can allow investors to interactively see and understand the implications of their choices.
Yes, sir.
They can tweak their sustainability preferences, say, emphasizing biodiversity over carbon, or vice versa, and immediately see how that choice impacts the projected risk and return profile of their portfolio in real time. This iterative process creates a much deeper, unique sense of ownership over the final portfolio shape. It's their values reflected in the numbers.
Okay, this battle between control and innovation, the unmovable object and the unstoppable force, it's clearly not just happening on trading desks or in tech labs. It's playing out very visibly on the geopolitical stage now, isn't it? Especially around semiconductors and data sovereignty.
The semiconductor industry is the perfect microcosm of this entire conflict. It's gone from being a poster child for globalization to being ground zero for strategic competition. Chips are now treated as critical, almost military assets.
Leading to a push for autonomy.
Guarded autonomy, yes. Nations want control over their own supply. The U.S. is using its massive capital leverage, the unmovable object, to try and steer the unstoppable force of chip innovation. We see this with preparations for sweeping tariffs, some potentially near 100% on certain Chinese imports.
And potentially taking stakes in companies.
Yes, strategically considering taking equity stakes in domestic chip makers like Intel, often tied to receiving substantial grants from things like the GPS Act. It's direct state intervention to bolster domestic capacity.
And this puts allies in a tough spot.
Immense pressure. Look at the requirement for annual license renewals for key allies like South Korea's Samsung and SK Hynix to continue supplying advanced chip-making equipment to their own factories located in China.
Forcing them to choose.
Essentially, yes. Balancing their access to the huge Chinese market against maintaining favorable tech access and relations with the U.S. Meanwhile, China is pushing back, initiating anti-dumping investigations into older but essential U.S. analog chips, and reportedly considering restrictions on buying high-end AI processors from companies like NVIDIA.
It really signals that nations now view tech supply chains with the same strategic urgency as military defense.
That's precisely the shift. The EU is actively calling for an EU Chips Act 2.0, explicitly arguing that semiconductors are now a strategic industry on par with aerospace and defense, demanding greater European resilience and autonomy.
Even Taiwan is playing hardball.
Absolutely. Taiwan, which dominates advanced manufacturing, reportedly refused a U.S. proposal to relocate half of American chip production needs to the U.S., clearly understanding and asserting the geopolitical leverage its semiconductor dominance provides. The era of purely efficiency-driven, globalized supply chains is over. The age of semiconductor sovereignty is here.
Okay, shifting from chips to regulation. The sheer dominance of digital platforms has triggered a global pushback, hasn't it? Governments trying to protect citizens, especially younger ones, from some of the negative impacts, trying to fence off the digital playground, so to speak.
Yes, we're seeing significant regulatory momentum globally, often focused on youth mental health and data control. Australia is moving ahead with a ban on social media for under 16s, putting the onus on platforms for age verification. It's set to take effect in December 2025.
And France?
France is proposing similar measures, even including automatic nighttime curfews disabling accounts for 15 to 18-year-olds during late-night hours to combat potential addiction and sleep disruption.
And here in the U.S., regulators are looking closely at AI's impact on kids.
The FTC, the Federal Trade Commission, has launched a detailed investigation into AI chatbot safety, specifically their potential harm to children and teens. This is clearly the government trying to exert control over the unpredictable outcomes of this new unstoppable force of generative AI.
Are the tech companies responding?
They're definitely trying to get ahead of regulation. OpenAI, for instance, introduced a specialized version of ChatGPT aimed at teens, with built-in age prediction tech and parental controls over certain features. Meta is also tightening default privacy settings for teen accounts on Facebook and Messenger.
Okay, let's talk about the ultimate geopolitical control play. Defining digital borders and potentially seizing control of platforms themselves. The whole TikTok saga seems like the prime example here.
It perfectly encapsulates the tension between the economic allure of a globally popular platform and deep-seated national security concerns. The U.S. executive order essentially forced a restructuring, paving the way for a new American-led company to take majority ownership.
With ByteDance retaining only a minority stake?
Less than 20%, yes. But the critical mandate, driven by concerns about China's national intelligence laws potentially compelling data access, is a requirement for all American user data to be stored exclusively on Oracle-managed servers located within the USA.
And oversight of the algorithms.
And oversight of the crucial recommendation models by U.S. security partners. It's not just about who owns the shares, it's about fundamentally controlling the data flow and the core technology to mitigate perceived security risks. Data residency is key.
And beyond national security threats like TikTok, we're seeing significant regulatory and financial pushback against platform dominance more broadly.
Absolutely. The penalties are becoming substantial. Look at the EU fining Google nearly $3.5 billion for abusing its dominance in digital advertising, basically, rigging search results to favor its own ad services.
And Amazon.
Amazon agreed to pay a massive $2.5 billion to settle FTC charges over deceptive practices related to enrolling users in its Prime membership without clear consent and making it deliberately difficult to cancel. These are direct government attempts to impose structural controls on platforms that achieve dominance through sheer innovative velocity, but perhaps cross lines in consolidating that power.
And finally, this battle for control extends even to the future of money itself.
Correct. China is proactively trying to shape the future financial landscape by opening a dedicated digital RMB hub in Shanghai. The explicit goal is to accelerate the global adoption and use of its central bank digital currency, strengthening its position in international financial services. It's another strategic layer, extending the competition from chips and data right into the core infrastructure of digital finance. So if we try to synthesize all of this, I think the primary takeaway from our deep dive is that this perceived choice, investing in the unmovable object like stable capital control and infrastructure, or the unstoppable force like disruptive innovation, it's becoming a false dichotomy.
It's dissolving.
I think so. The real strategic imperative now for companies and investors is synthesis. We're literally building advanced financial tools like those context-aware LLMs we discussed, not just to predict markets, but to systematically quantify the subjective, qualitative value of future potential. We're building bridges between those two worlds, making them interdependent.
So that integration, that ability to blend the two, that's the new definition of competitive advantage.
I believe it is. The modern investment landscape demands mastery of both dimensions. You absolutely need the deep, systematic, evidence-based logic of the quant world to manage risk effectively, strip out emotional bias, run the complex plumbing of global capital efficiently.
The unmovable object.
Yes, but you equally need the agility, the thematic insight, the qualitative understanding that comes from cutting-edge data science and fundamental analysis to anticipate and actually capture value from the disruptive technological and geopolitical shifts happening constantly.
The unstoppable force.
Exactly. So the ability to integrate the old certainties of systemic control with the new uncertainties of perpetual innovation, that isn't just one strategy among many anymore. It feels like it's becoming the essential operating system for defining market dominance and building lasting value in the 21st century.